Well, hello and welcome to Lesson 5 of the Introduction to Financial Accounting. Chapters 8 and 9 are included in this week's material. We begin with Chapter 8, Accounting for Long-Term Assets, Equipment, Plant, and Land. Current assets are also referred to as working capital. These are short-term and are consumed or turned over in less than a year's time. We discussed them in an earlier chapter. Long-term assets are used for more than a year before they are used up. Some assets, like land, have an indefinite lifespan and are never used up. Long-term assets can be tangible or intangible. Tangible means you can actually observe the asset. Has a physical presence. Intangible is an idea like a trademark or copyright. Tangible assets include property, plant, and equipment that are subject to depreciation. That is, they are used and used up over time, again with the exception of land. A second category is a natural resource. Some, like lumber, are renewable. Others, like mineral deposits, are subject to depletion rather than depreciation. Intangible assets can have a limited life or an unlimited useful life. A patent is one that has a definite length of useful life. That is, it expires after 20 years unless renewed and can only be renewed one time. Trademarks have useful lives that span centuries in many examples. For example, Coca-Cola, or probably the most popular trademark in the world and of all time, the US dollar, which has not changed much since the earliest days. When valuing long-term assets, accountants use the historical cost concept most of the time. This historical cost is based on the principle of conservatism, which is you want to record those items which can actually be documented. Historical cost is much more easily documented than, say, market value, which would be an alternative. Building valuation will include things like purchase price plus sales, plus taxes and title, plus transfers costs, plus realtors and attorneys fees, plus remodeling costs, minus accumulated depreciation. This gives us the value of the building based on the historical purchase price and any changes or improvements made. Land is valued at purchase price, plus sales taxes, plus title and transfer costs, plus realtors and attorneys fees, plus demolition costs of old buildings, and including grading costs. Equipment and machinery are treated similarly. Historical costs are preserved in the accounts separate from depreciation allowances and other ups and extras like sales taxes and so forth. The simplest, several methods of recognizing depreciation are then allowed under the generally accepted accounting practices. The simplest is called straight-line depreciation. The purchase price is divided by the number of estimated years of life, and that amount is recorded each year until the asset is either scrapped or sold. If it has a scrap value, that is, or a sale value at the end of its useful life, we add that in to figure the total value of the product or of the asset. Depreciation is recorded in a contra account separate from the book value or carrying value of the asset. Let's get a little more specific on that scrap value. When an asset is used up and discarded, scrap value is recorded as either a gain or a loss. If the asset sells for less than book value minus depreciation or depletion, it is called a loss. These gains or losses are not recorded on the income statement as cash flows like regular revenues and expenses, since they are one-time events. Thus, they appear under a separate heading as gains and or losses in the investing section of what we call the classified income statement. A second depreciation method is used and it is termed double declining balance. This is an accelerated write-off that reflects a higher cost of use in the early years of the asset's life and less in the later years. The textbook goes into the calculation that is done for double declining balance. It's fairly simple. and we'll take a look at it in class. Under either method, no asset can be depreciated below a zero value. There is a third method sometimes used called units of production depreciation. And this is based on the estimated production of the asset for its entire useful life and is recorded as the asset is used each year as a number until we finally reach the magical number upon which the asset should be reevaluated for either scrap or salvage. Since depreciation expenses are estimated, they are subject to revision, either based on shorter or longer useful life or revision of the salvage value. And we make these revisions into separate accounts as gains or losses, of course, as we noted earlier. When accounting for expenditures on plant assets, some costs are treated as expenses, for example, repairs, and some are capitalized, that is, they're included in the final value of the product. Repairs that extend the useful life of a machine would be an example of this. So we adjust the asset value by the amount of the outlay. With natural resources, we term the use of such as depletion rather than depreciation. And the concept is similar. Again, we have a variety of methods available, either a straight line or accelerated process. Trademarks, patents, copyrights, and franchises and goodwill are all intangible assets. Goodwill, based on the reputation of the company, is treated somewhat differently from the others, so we'll talk about it separately. This chapter closes with a discussion of the effects of judgment, estimation, and industry characteristics on asset values and on ratio analysis. Chapter 9 then covers accounting for current liabilities and payroll. The key operating concept at work here is called the going concern assumption. This means that the firm is expected to be operating and paying all of its obligations in full for at least the next year. Possibly more, but that is not under consideration. We take it a year at a time. This is because firms can go out of business literally at any time, but if they are a going concern, this is going to affect the way in which we value various assets and in which we treat the various liabilities and payroll items. So all liabilities, therefore, are recorded at face value. We've already discussed promissory notes in earlier chapters. Other short-term liabilities include sales taxes, contingent liabilities, warranties, and payroll accounts, including pensions. Each of these has its own peculiar twists that we will talk about in class. Payroll is especially complicated by a variety of mandated benefits that the employer must pay in addition to base or salary or hourly pay. Some of these are required by the federal government, some by the state. If the firm is operating within a major city, there may be city payroll taxes as well. This concludes the lesson 5, chapters 8 and 9. Be sure you take a close look at the vocabulary for each, as that is probably the most important thing to remember from each of these chapters as we're covering them so that you're familiar with the terminology. Look forward to seeing you in class this week. Thank you for tuning in. Bye-bye.